Let's begin with understanding who the liquidity providers are and who the liquidity takers are, the trading volumes of market participants, and hence their contribution to the foreign exchange prices. When studying different market participants, we need to understand that the trading objectives of the participants or the trading motives of the participants might differ. However, a common objective of all market participants is to maximize their foreign exchange returns. So we have importers, exporters, retail investors, financial investors, and market makers. They all have the task of forecasting rates in order to maximize their returns. However, the extent to which information is available to each of these participants to achieve this objective differs across participants. Interbank dealers, large financial institutions, have much more access to critical financial information than retail and corporate investors. They also invest heavily in technology, and hence these large volume dealers play a much larger role in influencing foreign exchange rates. Research also shows that these dealers are much better at forecasting foreign exchange rates, and they're much better at money management and therefore more profitable than retail and corporate traders in general. As most of us are aware, the need for currency trading emerged as a result of international trading in goods and services, basically exports and imports. Banks who managed these currency requirements for these importers and exporters needed to manage their own currency risk. Now take the example of a US company that imports auto parts from Japan. The US company needs to buy yen and sell USD at some future date and may enter into a forward contract with their bank as of today. This would result in the bank being short yen and long dollars for the same tenor. If the dollar weakens against the yen, the bank would start losing money on this trade. So basically the risk was passed on from the importer to the bank. Now, as a result of these foreign exchange risks from various importers and exporters, interbank dealers or market makers emerged in order to square their FX risk rather than warehouse the FX risk. By warehousing trades, we mean holding on to trades for longer durations, for example, instruments like stocks and bonds.